Tens of billions of dollars of tax cuts and higher superannuation contributions kick in today at the start of the new financial year. The S&P ASX 200 finishes the last financial year up 8% with tech stocks leading the way, and Perth, Brisbane and Adelaide take the gongs for strongest house price growth. Welcome to Fear and Greed Daily Business News for people who make their own decisions. It is Monday, the 1st of July, 2024. I'm Michael Thompson and good morning, Sean Aylmer.
Good morning, Michael.
Sean, the main story this morning, it is 1 July and there are a range of changes that kick in from today, from income tax cuts for employees to superannuation guarantee rate increases for employers.
Plenty going on this year, more than most. Everyone can expect more money in their pay packet as a result of the Stage 3 tax cuts, which in total are worth more than $100 billion. In short, there's no tax if you earn up to $18,200, 16% rate kicks in up to $45,000, 30% up to $135,000, 37% up to $190,000, and 45% after that. There is also an increase in the minimum wage, which affects 2.6 million Australian workers. The minimum wage rises 3.75%. That's from $23.23 an hour to $24.10 an hour. There's changes to paid parental leave, extra couple of weeks there. Also, there will be $75 energy rebates each quarter during this financial year. There's indexation of welfare payments, and the superannuation guarantee will rise from 11% to 11.5%. Yesterday, the Prime Minister, Anthony Albanese, was at an Indian sweet factory in Melbourne. Unusual, spruiking the cuts as part of the government's response to the cost of living crisis. He said 13.6 million Australian taxpayers will get a tax cut today.
Sean, do you reckon there's many people that are out there doing their tax returns today? You know, like Ned Flanders on The Simpsons. And of course, because the US operates on the different fiscal year, that they're January to January. As soon as the fireworks went off on the 1st of January, Ned Flanders sits up, bolt upright in bed and says, I better get going on those taxes. Do you reckon there's many people out there getting going today? Because of course it's faster now with the one-touch kind of the payroll tax reporting now. You don't need to wait for your group certificates.
Yeah, and I think there's a stack of people who do it because many of them get a refund. And so what you do it, and then if you realise that you're not going to get a refund, you just let it lay in abeyance for a little while. If you're not getting a refund, push the send button.
Yeah, there's a big incentive to get going early, isn't there? Now, while the government was pushing hard on all the good news, not quite everyone in the Labor Party was playing ball.
Yes, Prime Minister Anthony Albanese yesterday suspended Senator Fatima Payman from Labor's caucus after she defied his leadership, vowing to again cross the floor to back pro-Palestinian motions. The first-term MP from Western Australia last week voted for a Greens motion for the Senate to recognise Palestine as a state. She was subsequently barred from attending this week's caucus meeting. Yesterday, she doubled down on that one. She told the ABC she had received the cold shoulder from some colleagues as she more or less invited the Greens to continue moving pro-Palestinian motions, thus denying her party again. The second act of defiance earned her a red card from the Parliamentary Labor Party, thus taking some of the limelight off the tax cuts and welfare payment increases arriving today. Apparently, the Prime Minister is not impressed.
I can't imagine he would be, no. Now, of course, Sean, it was the end of the financial year. How did the market end off on Friday? And what's it mean for the full fiscal year, if you were to extrapolate that for the full 12 months?
No extrapolation needed, Michael. Just check it out, what it is. The S&P ASX 200. You were thinking forward, so weren't you?
Yes, I was, Sean. Yeah, thank you for rescuing me. You know, sometimes when you just go, I don't know if I've used the right word there. Oh, well, I'm going to roll with it and hope nobody notices. And you did. Yes, you did notice. Thank you.
I normally do that. The S&P ASX 200 closed up slightly on Friday to 7,767.5 points. 7,767.5 points, meaning for the full year, the benchmark index finished up 8%. Winners and losers for the last financial year. Well, it was the tech stocks that had the standout 2024 fiscal year, with the technology index up 29%. Financials jumped 23%. That's still pretty good. The consumer discretionary index was up nearly 20%, and the real estate investment trusts index was up 17%. While the technology stocks did well on the back of AI and data centers, that sort of stuff, the next three sectors, the financials, consumer discretionary, and REITs, did well because of expectations that interest rates would fall. Ironically, it didn't actually happen last financial year. And in fact, we're not even sure that's going to happen this financial year. In actual fact, Michael, interest rates went up last financial year, but let's just park that. The worst performing sectors last year were consumer staples and energy. Their respective indices were down 7%. The materials index finished the year down 6%. Turning to the currency market. Michael, I know you're excited about this one.
I'm literally beside myself. No, not literally, actually. I'm figuratively beside myself. I've done it again. I'm not having a good day, Sean.
The Aussie dollar finished the year at 66.7 US cents. Let me tell you where it started, Michael. Finished at 66.7 cents. It started at 66.7 cents. Yep, it went nowhere.
So hang on. But there wasn't even much movement through the rest of the year.
Well, yeah, I mean, it's true. It traded in this really narrow range. So it got almost to 69 US cents last July. Not quite. It dipped under 63 US cents in October. But mostly it's been in that 65 to 66 cent range. Now, we've discussed on this, my first ever journalism job was writing in the Sydney Morning Herald the report about what the Aussie dollar did. Could you imagine spending 12 months explaining the Aussie dollar did nothing?
Did very, very little. And one of the highlights is all of a sudden when it jumps by 0.5 cent. And you're like, oh my God, it's crazy. Hold the front page.
That's exactly right. Yeah, anyway, Aussie dollar ended where it started, literally.
Now, Sean, immediately after the show, it is a great interview you have today. You are speaking with Dr. Shane Oliver, Chief Economist at AMP.
Yes, look, it's the beginning of the financial year. That's what we've been talking about. So we ask Shane about his 9 tips that he's learned over 40 years of investing. And Shane, as always, communicates them very clearly, very sensible tips. And given he's got 40 years of knowledge under his belt, they're just fantastic things. I mean, many people would do them anyway, but they're just great reminders. Some of us, you think, yeah, I should have thought about that 20 years ago. Anyway, it's well worth a listen if you're interested in investing.
Yeah, it is a really good interview. It's coming up after the show. Now, checking international markets, thanks to Blue Chip Communication, the experts helping financial services companies market, communicate and grow. Visit bluechipcommunication.com.au. What's happening, Sean?
Well, most sensible countries in the world don't have a financial year end of 30 June, so there's much less excitement about what's going on. We don't have Ned Flanders waking up wanting to do his tax returns or anything at the moment. Over the weekend, both the S&P 500 and tech-heavy NASDAQ closed lower after new data shows the Federal Reserve's favoured inflation measure was unchanged in May. For the first half of 2024, so half the financial year in the US, the S&P 500 added 15.1%. The NASDAQ was up 20%. NVIDIA is a big part of that. That is quite the rally. I mean, imagine if you double that. Tech stocks would be up 40%. Wow. Oil prices are trading around $85 a barrel. They're up a bit this year, Michael. Gold's fetching around $23, $26 an ounce. I think that's all I'm going to say about the end of the financial year.
You're done.
I'm done. It's exciting. I think I'm done. I don't know. We'll see how we go.
That's a good wrap. A good wrap. We'll be back in a moment with the rest of the day's business news. Sean, Federal Treasurer Jim Chalmers has approved ANZ's $4.9 billion acquisition of Suncorp's banking business. It's nearly 2 years after the deal was first proposed.
ANZ Chief Executive Shane Elliott said the deal will make ANZ a tougher competitor with rivals Commonwealth Bank, Westpac and National Australia Bank. It will be the biggest merger in banking since Commonwealth Bank took out Bank West during the global financial crisis back in 2008. The ANZ Suncorp deal was initially knocked back by the competition watchdog in August last year. That decision was overturned by the Australian Competition Tribunal. The Treasurer on Friday said the deal was in the national interest, but he put some conditions on the merger. ANZ won't be able to close any regional branches anywhere in Australia for 3 years, and the government wants ANZ to make every effort to join Australia Post's banking service. Currently, it's the only one of the big 4 banks that doesn't allow banking through the Aussie Post outlets. Obviously, plenty of work has already been done on this one because the 2 companies are targeting a July 31 completion date. ANZ's share price was down slightly on Friday. Suncorp's rose nearly 4%.
Sean, it looks like all the talk of interest rate hikes might have spooked buyers a little over the weekend, with the preliminary clearance rate for auctions across the country coming in at 70%. That's down 2.4 percentage points from a week ago.
There was also a drop in the number of auctions, according to CoreLogic. Melbourne's preliminary clearance rate came in at 68.2%. Sydney was 72%, was actually higher than a week ago. Adelaide, 82%. Brisbane, a touch under 63%. Basically, the winter slowdowns kicked in, which is kind of normal, though you do wonder about all that talk of rate hikes last week. I'm sure that didn't help things. Michael, I have to go through. I said I wouldn't do an end of the financial year thing.
But you're going to. Go on.
Yeah, housing market. Well, Perth led the way last year. Dwelling values on average, according to CoreLogic, up 24%.
In 1 year. That is extraordinary.
I know. It's ridiculous. Brisbane was 16%. Adelaide's 15%. They're extraordinary. Sydney was probably more normal at 6%, but even that's kind of well above inflation. So it's pretty good. Darwin and Canberra were just over 2%. Melbourne was 1.3%. Hobart dwelling values were actually flat for the last financial year. Actually, they declined 0.1%, so officially they went backwards. But certainly it is the story of Perth, Adelaide and Brisbane taking off, Sydney doing okay. The rest, Darwin, Canberra, Melbourne and Hobart, not so well.
That Perth number is just amazing. Now, insurance group IAG has entered into strategic deals with 3 overseas global reinsurers to improve its financial stability against claims related to unpredictable extreme weather events.
This is all a bit complicated, but reinsurance is basically insurance for the insurers. So insurance companies around the world all get together. So we're going to insure each other so that we share the cost. The deals that IAG has done over the next 5 years provides up to $680 million of additional protection. That's annually, and up to $2.8 billion over the entire 5-year period. Basically, it allows IAG to put a limit on how much it would have to pay out if there was a natural disaster. Everyone likes that idea. Chief Executive Nick Hawkins said the agreements will help provide greater certainty over natural perils, such as extreme weather events, particularly as they become more frequent and severe. Certainly shareholders like the idea. Its share price closed up 7% on Friday.
Meta, owner of Instagram and Facebook, has threatened to block news from its platforms in Australia and stop local users from sharing links to news articles if the government decides to force the social media giant to negotiate payments with news organisations. It feels like we've been here before, Sean.
Yeah, we did this in 2021. Now, this move is an escalation in the dispute between Meta and the government and local media companies. It was reignited in March when Meta said it wouldn't renew its existing deals with news organisations. Under the News Media Bargaining Code, designated digital platforms are required to enter into commercial deals with media outlets or face fines of up to 10% of their local revenue. Assistant Treasurer Stephen Jones has to decide which digital platforms to designate under the code. Now, if Meta is designated under the code, then as its local boss, Mayor Garlick, told a parliamentary committee on Friday, all options are on the table. That could mean Meta permanently blocking news. Now, it's done it in Canada after a similar battle to force it to pay for content. So it's not a veiled threat. It actually could do it.
Yeah, and in a related story, Sean, Nine Entertainment will cut around 200 jobs as a result of a weaker advertising market and the end of that previous content deal with Meta.
Yeah, so between 70 and 90 positions will be made redundant across its publishing business. That runs the Sydney Morning Herald, The Age and the Australian Financial Review. There will be some cuts within television, news and current affairs. The remainder will come from corporate and digital. Nine Group has around 5,000 staff. The job cuts represent about 4% of the workforce.
Okay, turning to international news, it is a big week in Europe for elections, Sean, with France going to the polls today, Australia time, and the Brits voting at the end of the week. This is massive.
It is. In France, it's the first round of polls that are underway as we speak. The far-right party of Marine Le Pen is expected to win, ahead of a broad left-wing alliance called New Popular Front. In third, according to the polls, is President Emmanuel Macron's centrist bloc. Now, the top two go to a second ballot later in the week. And at this point, it looks like Macron's party is going to miss that. A second ballot between the two leading parties occurs next weekend. The winner becomes Prime Minister. Macron remains as president until 2027. But if it all goes as the polls suggest, the right-wing party, National Rally, it wins. Its party chief is a guy called Jordan Bardella, who is Marine Le Pen's 28-year-old protege. Absolutely no governing experience, but he could well become Prime Minister in what's known in French as well, I'm not going to have the accent here, but the cohabitation is the word, cohabitation with Emmanuel Macron. That would make running the country very, very challenging, and that looks like the most likely outcome as we stand here today. Then on Thursday, UK time, the Brits vote. According to the polls, the governing Conservatives, led by Prime Minister Rishi Sunak, will be slaughtered. Absolutely wiped out by Labor. The new Prime Minister will be a guy called Sir Keir Starmer.
Yeah, it certainly looks pretty likely that it's going to go that way. I mean, stranger things have happened, but it'd be pretty unlikely, right?
Not many. Yeah.
Now, one last one, Sean. A big one. Nike, the world's largest sportswear company, has downgraded its earnings outlook on the back of waning demand for its sneakers and apparel.
Yeah, the owner of Jordan and Converse Apparel said revenue was declining rather than expected growth of about 2%. Shares fell by 20% over the weekend. It had actually dropped 17% over the past 12 months ahead of that anyway. Nike executives blamed the slowdown in part on lifestyle brands, including Air Force One and Nike Dunks, which basically just aren't selling as well. Most of their sales are now online, but they're not selling like they did. The lifestyle category sales fell, in fact, for the first time since the start of the pandemic. It's added urgency to Nike's efforts to speed up product development. There's also plenty of new competitors. So On Holding AG and Hoka running shoes, they're apparently doing very well. Nike's promised to prioritise sports, new products and wholesale partners.
All right. Now, up next, Sean, we have Fear and Greed the week ahead, featuring our resident economist, Stephen Koukoulas.
Massive week this week. We've got lots of partial bits of data like retail sales and building approvals. Plenty for Stephen to get his teeth into. We also talk about those inflation numbers last week and where we're at with interest rates.
Yeah, it is a good one. And then after that, we have the Fear and Greed daily interview with AMP's Dr. Shane Oliver.
Shane's 9 tips that he's learnt from trying to look at the market for 40 years. Well worth a listen, that one.
Yeah, it certainly is. They are coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au, which is also where you can sign up for the free weekly newsletter, which will be out midweek on Wednesday morning, mid-morning, always full of great stuff, plenty of opinions and plenty of views on the news of the week. Thank you very much, Sean.
Thanks, Michael.
It's Monday, the 1st of July, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X, TikTok and Facebook. I'm Michael Thompson and that was Fear and Greed. Have a great day.